This is a video for Finance 438, Management of Financial Institutions at California State University Northridge, and I'm Jim Dow. There are three major parts to the financial system. The payment system is the part that handles payments. Issuing currency, processing checks, handling credit cards are all part of the payment system. Insurance and risk management is another important part of the financial system, providing life insurance, car insurance, and working with businesses to reduce risk. Capital markets are where people with money to invest meet people who are trying to raise money. This could mean buying stock issued by a company or depositing money at a bank that will then lend the money to someone to buy a home. We will spend most of our time talking about institutions in the capital market. Some institutions participate in more than one activity. For example, banks play a role in both the capital market, making loans, and in the payment system, providing checking deposits. Insurance companies are, of course, part of the insurance system, but are also part of the capital market as they invest the premiums they receive. Let's take a big picture look at the capital market. There are suppliers of funds, people who have money to invest, and demanders of funds, people who want to borrow money. The book uses the names deficit spending units and surplus spending units, but they're kind of awkward, so we'll stick with demanders and suppliers of funds. The capital market is a way of connecting demanders and suppliers of funds. This is done in two ways. If a company raises money by issuing a security and selling it to an investor, for example, when a company raises money by selling a bond, we call this direct finance. On the other hand, if both the demander and supplier are connected by their relationship through a financial intermediary, we call this indirect finance. For example, a depositor puts money in the bank and the bank lends that money to a company. While there is no direct connection between the company and the depositor is indirectly lending money to the company. Sometimes we'll talk about how individual financial markets work, which mostly involves direct finance. And we'll also talk about financial institutions, which primarily involve indirect finance. However, these are terms of convenience. There's often no sharp line between direct and indirect finance. Another important actor in the financial system is the government. They may participate directly by issuing currency or borrowing money, or they may act as regulators of financial markets and institutions. There are many different parts to the financial system. Some we will cover in detail, others we will only mention. Also, the book covers more parts of the financial system than we will in this class. The word market is used in a number of different ways. We can use the term market as an abstraction. For example, we can talk about the market for apples in general without meaning any particular buyer or seller or type of apple. We can also talk about a market as a location. Maybe there's a farmer's market down the road where people buy and sell apples. The same holds in finance. We can talk about the stock market in general, all the people issuing stock and holding stock, or we can talk about the New York Stock Exchange, a particular place where stocks are sold. We can also categorize markets in different ways. We can divide up markets by what is sold there, for example, stocks or bonds, or by what is accomplished in the market. When a company first issues a security, it sells it in order to raise money. We call that the primary market. When somebody who has bought a security sells it to someone else, we call this the secondary market. The secondary market doesn't raise money for the issuers, but it provides liquidity to the people who hold the security. We can also describe markets by how the securities are sold. In a broker market, a broker connects a buyer and seller. For example, a real estate broker connects someone with a house to sell with somebody who wants to buy a house. The broker doesn't have a stock of homes that it has to sell. In a dealer market, the dealer does keep a stock. For example, a car dealer keeps a stock of cars that it will sell to you, and they will buy used cars from you to add to their stock. The book categorizes markets by what they exchange. There are 3 chapters on debt instruments, one on the bond market, one on the money market, and one on the mortgage market. There is a chapter on equity markets. There is a chapter on the derivatives markets. Derivatives play a role in both investing, the capital market, and in risk management. There is also a chapter on the foreign exchange market, which also plays a role in the capital markets and is an important part of the payment system. We will also look at a number of different financial institutions. The major focus of the course is on commercial banks and related institutions, such as thrifts and credit unions, and finance companies. Also important are investment banks, hedge funds, and private equity funds, although we'll spend less time on them. Investment companies are institutions like mutual funds, and they'll fit more in an investments class. There are also a number of different government agencies involved in regulation. The Federal Reserve takes part in many aspects of the financial system. It handles interbank transactions, it issues currency, it regulates banks, and controls monetary policy. Because of its central position in the financial system, it gets its own sections in the book and in the class. The Treasury Department is the fiscal arm of the federal government. It borrows money for the government through Treasury securities, and it is involved in regulation. There are also specific regulatory agencies, such as the Securities and Exchange Commission. There are equivalent international institutions in every major country. Countries with their own currency, or regions with their own currency, such as the Euro region, have a central bank that performs the same roles as the Federal Reserve. There are also international financial institutions, such as the World Bank, who coordinates lending to developing countries, and the International Monetary Fund, or IMF, who works with the industrialized countries, encouraging international cooperation on economic issues. There are also private regulators. The Financial Industry Regulatory Authority, or FINRA, is a not-for-profit organization that oversees broker-dealers in the investments industry and is known for its exams, such as the Series 7, for people who want to work in that industry. We'll end this section with some terms and ideas that matter when studying financial markets. While we'll focus on intermediation, such as taking deposits and making loans, financial institutions, particularly banks, do other kinds of intermediation as well. Maturity flexibility involves taking an asset of one maturity and turning it into an asset of a different maturity. We will see this most commonly with loans. A bank may make a 5-year loan and fund it with 1-year deposits. Instead of having to commit their funds for the 5 years of the loan, the depositor gets a more liquid asset that they can withdraw in a year. However, as we'll see in a later lecture, this is a source of risk for the bank. Denomination divisibility refers to taking assets of one denomination and turning them into assets of another denomination. For example, a bank may make a loan for hundreds of thousands of dollars or millions of dollars, which is much more than a typical depositor can come up with. But by combining the money from thousands of depositors, small denomination accounts can be used to, indirectly, purchase large denomination assets. Credit risk diversification is a way that banks can reduce risk for depositors. If 10 depositors pooled their money to make one mortgage loan, they would be faced with losing a substantial amount of their money if that borrower failed to pay back the loan. On the other hand, if thousands of depositors pool their money through a bank and make hundreds of loans, they can lose a little if 1 or 2 of the loans fail, but it's unlikely that all the loans would fail. Pooling their money to invest in many different assets is a way of reducing their risk. Currency transformation involves buying financial claims in one currency while selling financial claims in another currency. A bank may have liabilities denominated in one currency and assets denominated in another. There are also a number of costs or problems that affect financial markets. Transactions costs are not only monetary costs that are paid in a transaction, but also time costs such as search costs. It would be expensive for you to look around to find someone to lend your money to and to evaluate their creditworthiness. It's better for you to go to a bank because they specialize doing this and will have lower costs. Asymmetric information is when buyers and sellers have different information. For example, when a bank lends money to an individual, the individual has more information about whether they will repay the loan than the bank does. Sometimes asymmetric information is a barrier to getting a transaction to happen. For example, a bank may simply not have enough information to trust that a loan will be repaid, and so, absent any security, will not make the loan. Asymmetric information can cause problems before a financial transaction in the form of adverse selection. Say that I know there are high-risk borrowers who I should lend to at 10%, and low-risk borrowers I should lend to at 4%, but I can't tell who is whom. If I charge an average interest rate of 7%, the low-risk borrowers might try to find a better deal somewhere else. But the high-risk borrowers would see this as a cheap source of funding. So the pool of borrowers is mostly the high-risk borrowers. So the bank ends up lending at 7% to borrowers it should charge 10% to. This is an example of adverse selection. The people who select to be in the group are not the average, but rather the ones that are worse. That's the adverse part. Moral hazard is when, after making a financial transaction, one of the parties changes their behavior. A company might be run very efficiently to make it look like a good candidate for a loan. However, once it gets the loan, it no longer has that same incentive, and so it may take actions that make it less likely to be able to repay the loan.